think the final reading on GDP would just give the market and also the Fed more confidence to embark upon that rate hike in June?
I think it should. I think it should because if you look at where the Fed is right now, it's clearly around 250 to 300 basic points behind the curve. I think that data has been strong enough, both in consumer confidence and CapEx also, to prove that there is not a risk of making a rate hike at this point. I think it's very important also to give confidence to the markets, because if the Fed continues to delay the decision, they're going to get into a situation in which the market might start thinking, hey, they know something that we don't. They are worried about something. So I think that it's very important to give that level of normalization to the monetary policy, because they need tools as well if there is a change of cycle.
We know what they're worried about is price stability, and James Bullard mentioned that when he was in Tokyo last week, saying it's worrisome. It's not quite the Japanese story, but it is still a concern for them. But he did give very mixed signals, then pointing out that the market is needing to guide up to where the Fed is on interest rates being delivered this year. So at the end of it, I was confused. Are we going for 3 this year? Are we going for more?
Yeah.
What's the scenario?
Well, I don't think it's going to be more than 4. I don't think it's going to be 3 either. Unfortunately, the Fed is too concerned about financial markets. And I think that the Fed should be looking at core inflation. Core inflation is where it should be. We need to understand that core inflation is not going to go to levels of, 3.5%, 4%. It's impossible with technology, with overcapacity in a globalized world in which China is not growing as we expected. So, but that's not a negative. That is not a negative. We need to see a little bit of improvement in productivity. Unemployment is working very well, and the Fed needs to worry less about the impacts on financial markets.
What about oil prices? Last week we had a huge focus around Vienna. We finally got a production agreement to extend for 9 months. Should mean more stability in the price. But some say, well, it could mean more cover for those US shale producers to come back into the mix. How is that going to play out for the inflation story around second-round effects?
Yes, I think we've spoken about it here a few times. I don't believe in the reflation trade. And I think that all this base effect that we have seen in the first 5 months of the year is going to fade out into the end of the year. But that is not a negative, because what I care about is core inflation, is inflation excluding energy and food prices. The oil price is not going to help, because the market is too well supplied, and the cuts from OPEC end up being the biggest gift to shale. At the end of the day, shale is going to continue to grow despite whatever is decided in Vienna or anywhere else. And not only just shale, but also disruptive technologies. Efficiency is playing a big part there as well.
So let's just explore how this plays out a bit for those OPEC producers and non-OPEC ones who signed up to the extension. There were reports in the market as they were coming up to the agreement that if there was an extension for 9 months, it would mean that come 2018, when the deal falls off the table, you would have a $30 price tag on oil, because all those extra shale producers would come into the mix. Do you think that's going to be the case, or is lack of compliance going to kick in as OPEC and non-OPEC members feel as though they've just been giving this gift to those shale producers?
I think that lack of compliance will start to kick in as the evidence that the deal is not working in terms of price kicks in, but also as revenues, or dollar revenues for those countries start to be an issue. At the end of the day, we need to think of the requirements of many of these countries to repay external debt, and their currencies, they are not going to be letting their currencies just weaken and weaken to drive inflation much higher, which would be a negative for their societies. Therefore, I think that they need to understand that striving for much higher oil prices is not going to be the good policy to work on. What they need to do is to understand that the market will gradually settle, but it's not going to be at the prices that they need. It's at the prices that, obviously, that the market is going to be generating, which is the competition.
Daniel staying with us, Daniel Lacalle from Tresses Gestion.